Hi, I'm Colin Szynski here today to talk about the advantages of trading with CMC Markets over exchange-traded funds. Before we begin, it's important just to go through a couple of quick definitions so we are all on the same page of what we're going to be talking about. What are exchange-traded funds? An ETF essentially is a mutual fund that's closed-end and listed on a stock exchange. And most importantly, it's passively managed relative to actively managed funds, which means that it's a mutual fund that buys a basket of assets, whether it's commodities or shares or currencies or something else, and basically sits on them and is listed to trade on the stock exchange. Some of the benefits of ETFs include access to products that people might not normally be able to trade, such as indices and commodities. There's no lockup periods. It enables traders to speculate on rising and falling markets. There is some leverage available between margin accounts and certain mutual funds, and returns are based on an underlying instrument. There are four major types of exchange-traded funds. There's equity ETFs, which track stock indices or a basket of stocks within a certain industry sector. There's commodity ETFs that hold specific commodities such as gold or crude oil or uranium. Leveraged ETFs are designed to deliver a multiplier of the performance of an underlying instrument using forward agreements. So for example, if you have a 2 times crude oil ETF, would mean that it's trying to deliver double whatever the percentage return is on crude oil. They try to deliver double that on the same day, whether it's upwards or downwards. An inverse ETF is similar to a leveraged ETF. It also uses forward agreements to generate a certain type of performance, but in this case, it tries to deliver the opposite performance. So it's designed for people that don't like the idea of short selling, but think that something's going to go down. They can buy a mutual fund that goes up when the underlying goes down. Although ETFs have become extremely popular over the last decade or so, they do have some limitations, which we're going to go through on the next several slides. Some of the disadvantages of ETFs include limited trading hours, trading costs, limited leverage, tracking errors, and an abstract price relationship between the ETF and the underlying instrument. For starters, ETFs have limited trading hours. Taking the E and T out of that, exchange traded means, of course, that they trade on the exchange and they're limited to the hours that the exchanges are actually open. In North America, this is 9:30 a.m. to 4:00 p.m. Eastern Time. However, many of the underlying instruments are available for trading on other markets 24-hour basis, such as gold and silver, crude oil, the S&P 500, the Dow, and overseas indices such as the FTSE or the Nikkei or the Hang Seng. And what's most important is not only are these markets available for trading, but particularly in the case of overseas indices, they may actually have their most active trading times when North American markets are closed. Because of the limited trading hours are also inconvenient for many people. 9:30 a.m. to 4:00 p.m. coincides with the business and working day in Eastern North America. However, if you're working full-time, you may not have time to trade, and therefore you might miss opportunities. 24-hour markets give you the ability to trade when it's convenient for you. You also have gapping risks due to the limited trading hours where these markets are, where many instruments can continue to trade even though North American exchanges are closed. You can miss opportunities to take profits. You can also miss stop losses, and it's a particularly big risk because you could end up taking deeper losses if something goes against you because of the limitations of the exchange. We're going to start with an example here of a missed take profit order. This is an example of a missed take profit, where if we look at this chart for U.S. crude oil is a 24-hour trading chart. It's important to realize that the smaller bands of time within this chart on each day are when the exchanges are open. The wider bands are when North American exchanges are closed. And one of the things this chart highlights is just how much opportunities are out there when North American markets are closed that people miss. So suppose you want to put a long trade on U.S. crude oil and you go in at about $110. You have an objective of about $111.50. So If you're trading in a 24-hour market and you can see that it's rallied overnight and you have your limit order to sell at 111.50, you would get executed there and be able to take your profits. However, once it ran up, it then quickly fell back down again, and by the time the exchanges opened, it was trading back around 109.76. So if you're trading in a 24-hour market, you were able to take your profits and run. However, if you were trading an ETF, you missed that move completely and you missed the opportunity to take those profits. Here's an example of a missed stop loss. Once again, the wider periods are when overseas markets are open. The narrow periods are the limited period of time that North American exchanges are open. So suppose you've entered a trade at 109.50 in US crude oil, and you've put in yourself a stop loss around 109.10. Now, if we look at this particular case, what's happened is that you've had a big sell-off overnight. So you closed, North American exchanges closed above your stop loss point. However, by the time the next morning came around, they had sold off and didn't reopen until it was at $107, which is way below your 109.50 stop loss level. This is particularly important because that's called slippage. That's a huge gapping risk because a stop loss order will become a market order when the exchange opens. So instead of getting filled at 109.50 like you would in a 24-hour market, you get filled at $107. That's a significant loss and a significant risk that you've taken on by trading an exchange instrument rather than a 24-hour trade. Another example here of the limited trading hours shows up in popular ETFs, and you can see these gaps in the prices. So we've used here a chart of HOU, which is a popular Canadian ETF that follows crude oil. And as we can see, it has, during the course of 1 week, it's had several significant moves on the open because of what's happened in overnight markets that ETF traders miss out on. The next thing to consider is trading costs. And there are a number of costs involved in a trade. There's commission, which most people are familiar with. There's also the bid-ask spread, the difference between the bid price and the ask price that you pay no matter what market you trade in. And because ETFs are mutual funds, there's also management fees. And if you do it in a margin account, you also may pay financing fees. So as an example of the kind of trading costs you might pay on an ETF, you might pay, say on 1,000 shares, you might pay $10 to enter the trade, $10 to get out of the trade, and then your bid-ask spread of 1,000 shares times a penny is another $10. So you might pay $30 round trip for a trade on an ETF. That would be your total trading cost of $30 plus your management expense ratio plus your financing costs. ETFs also have fairly limited leverage. Typically, it's 2 times leverage on an ETF, and particularly on the leveraged ETFs. It is possible to increase this a little bit with margin. If you used a 30% margin rate on a traditional ETF, that could give you about 3 times leverage. And if you used a 50% margin rate on a leveraged ETF, that gives you up to about 4 times leverage. So as an example, the Horizons Beta Pro NYMEX crude oil account ETF is HOU and HOD. It's a 2 times leveraged ETF that tracks NYMEX crude oil. The 1% increase in NYMEX crude oil should be mirrored by a 2% increase in HOU. However, when you do get involved in leveraged ETFs, there's a potential for significant tracking errors, which can cause a lot of problems. And because of this, leveraged ETFs are designed for intraday trading only. From day to day, you run into significant problems with tracking errors, and we'll go through an example here. So suppose you have the oil price moves from $100 on day 1 to $110 on day 2 and back to $100 on day 3. Well, if you look at the oil daily return, on day 2 it goes up 10% to 110, and it falls 11% back to $100 on day 3. When you used a 2 times leveraged ETF, it doesn't track the price move, it tracks the percentage move. So your 2 times ETF would go up 20% on day 2, it would fall 22% on day 3. So if you look at the ETF price, day 1 it's $5, rises 20%, goes to $6. Then the next day it falls 22%, the ETF price goes to $4.68. In comparison, the oil price would go over the 2 days from $100 to $100, zero return between day 1 and day 3. However, if you've owned the leveraged ETF, you've gone from $5 to $4.68 or taken a 6.4% loss. These tracking errors don't just happen over short periods like a day or two. Because of the way the leveraged funds are set up, tracking errors can be amplified over longer periods of time depending on how it trades. How something goes up or how something goes down and how it moves over time is quite important to the pricing of a leveraged ETF. So looking here at examples of the performance of the Beta Pro crude oil bull and bear and the Beta Pro NYMEX natural gas bull and bear. If we look first at the crude oil, we'll see over a 6-month period that you had a 17% increase in the price of crude. HOU, the bull fund, which should go up just as much as, which is supposed to go up 2 times that, instead of going up 34%, has only gone up 30.5%. The HOD, the bear fund, which would go down if the oil goes up, should be down 34%. It's down only 31.6%. And things get even more interesting when you look at the natural gas fund. Because when you look at the 6-month performance of the natural gas fund, it's over that period, natural gas itself is up about 2.7%. However, the bull fund is down 9.9% over that period. That's way more than 2 times. And the bear fund is down about 12%, which again is far more than the 2 times it's supposed to replicate. And even worse than that, if you look at this, the bulls lost and the bears lost. So this has really been over a longer hold period, was actually a lose-lose proposition. Another factor to consider in terms of limitations of ETFs is the abstract price relationship between the ETF price and the price of the underlying. And we saw this a little bit in our previous example where we had crude oil trading at $100 and the ETF trading at $4.68. And what this means is that sometimes it's hard to tell if you're looking at the underlying and you want to set a stop loss based on something like $100 oil, what does that mean in terms of the price of your ETF? What price do you set a take profit or a stop loss order at? It's particularly difficult with leveraged ETFs where this may change every single day. With CMC Markets, the price of our contracts is based on the price of the underlying. So $100 oil is $100 oil all day, every day. $13.50 gold is $13.50 gold every single day. With leveraged ETFs, the price can change from day to day. One day it might be $4.68 as $100 oil. One day it might be $5.02 or $5. It depends on what the price was the day before. It also means that if you're holding a leveraged ETF, you have to go back and adjust your stop loss every single day. If you're holding something overnight with CMC Markets, it'll be the same price the next day. There are a number of ways that CMC Markets can help you overcome the limitations of ETFs. We have a wider selection of products, longer trading hours, lower fees, stronger leverage, no tracking error, and a direct relationship between the price on CMC Markets and the price of the underlying. First, we'll show examples of our wide range of products. We have, with CMC Markets, you can trade several indices for North America, including the Toronto 60, the 4 major U.S. indices, the Dow, the S&P, the NASDAQ, the Russell, plus the VIX. International indices, you can trade from countries all over the world. In Europe, the FTSE, the DAX, the CAC, and others. In Asia Pacific, the Nikkei, the Hang Seng, the Australian market. We also offer a quite extensive array of commodity prices that you can trade, including not just the popular ones such as gold, silver, crude oil, also copper, natural gas, agricultural commodities such as wheat and corn, and soft commodities such as coffee, orange juice, lumber, and others. CMC Markets also makes extended trading hours available, and this enables you to trade for 2 things. You can trade 24-hour markets, which means that you can take advantage of news events that happen outside of exchange hours. So when 8:30 in the morning Eastern Time, when U.S. economic data comes out, you can trade it with CMC Markets right away. You don't have to wait an hour. Similarly, when news comes out from other regions during their trading days, you can trade right away with CMC Markets. You don't have to wait for stock markets to open the next day. This is particularly powerful for Asia Pacific markets where their news comes out in the evening, Eastern Time, and particularly suitable for people trading in Pacific Time, that their news comes out in the evening and you can take advantage of it right away. So some of the commodities we have 24-hour trading on include gold, silver, crude oil, natural gas, and other major commodities. For indices, the S&P 500, the Dow Jones, the FTSE, the DAX. The Nikkei and the Hang Seng are not quite 24 hours, but they are open during the same hours that their underlying exchanges are open. Extended trading hours enable you to reduce gapping risk. If the market goes down through your stop loss price, if you're trading in a 24-hour market, you convert into a market order right away. You don't have to wait for the next morning and run the risk that it may turn even farther against you. It also enables you to trade on pre-market and after-hours events. Trading with CMC Markets can also be significantly cheaper than trading with ETFs. Our fees are significantly lower. We're commission-free trading. We're a market maker, which means that we earn our money off of the spread between the bid and ask price, which you would pay whether you trade on our market or on the stock market or the futures market or really any market. Our spreads also tend to be narrower than what you might find in the stock market. There's no financing charges on commodities, and we're not a mutual fund company. We're a trading company. We do not charge management fees. Here's an example of the lower fees. Suppose you're trading 10,000 US dollars worth of crude oil and the price is around $100. One of the more popular Canadian ETFs on crude oil is the Horizons Beta Pro NYMEX Crude Oil Plus ETF, also known as HOU or HOD. This would require 1,000 shares to trade. So 1,000 shares times $5 a share times 2 times leverage to replicate the performance. With CMC Markets, you trade the crude oil price directly. You have one contract with CMC, 100 barrels per contract times $100 per barrel. So when we look at our fees, if you were trading the HOUT ETF, you'd have to pay $10 commission entering and exiting the trade. No commission with CMC Markets. $10 on the spread with the ETF, $6 on the CMC Markets crude oil contract. Daily interest of 27 cents a day on your margin balance with the HOU ETF. No financing on commodities with CMC Markets. Your total cost with HOU is $30 plus your daily interest plus your management fees. With CMC Markets, the cost for the same position, $6. CMC Markets also offers significantly stronger leverage. Typical leveraged ETFs gives you 2 to 4 times leverage. In contrast, CMC Markets can offer you significantly more leverage. Crude oil up to 20 times leverage. Natural gas about 10 times leverage. Gold about 16 times leverage. Silver 8 times leverage. Copper 20 times leverage. Similarly on indices, S&P 500 23 times leverage. NASDAQ 20 times leverage. Dow 28 times leverage. FTSE 6 times leverage. And the Toronto 60 21 times leverage. So significantly more leverage. If you're looking for leverage, you can get a lot more leverage with CMC Markets than you can with ETFs. And there's a number of advantages of having stronger leverage. One is that there's less capital required to enter into a position. It enables you to control a larger position, and it can magnify your returns, both positive and negative. So for example, suppose you were trading $10,000 worth of crude oil between HOU or CMC Markets. The value of the trade in an HOU would be 1,000 shares times $5, $5,000. Your margin rate is 50%, or equivalent to 2 times leverage, give you capital requirement of $2,500. CMC Markets, we talked about a $10,000 value of a trade, 100 barrels times $100. Using 5% margin or 20 times leverage, the capital required is $500 instead of $2,500 for the ETF. And there's no significant tracking errors with CMC Markets. CMC Markets contracts are based directly on the underlying price. We don't have tracking errors, we don't have compounding errors, and this enables you to take on long-term positions with CMC Markets that you can't take on with leveraged ETFs. This enables you to take on longer-term positions with CMC Markets than you can with leveraged ETFs. With CMC Markets, because our contracts are based directly on the price of the underlying, this enables you to take advantage of the publicly available charting services that are out there based on the underlying price, and do the analysis and then set your stop losses on CMC Markets. And whether you use external charts or our own charting package, you can easily set price targets and your stop losses, and you don't have to do calculations or go back every single day and adjust your trades because the values have changed. It's easy and it's consistent. CMC Markets gives you the ability to trade smarter. We offer a wide range of markets, lower trading costs. We enable you to make efficient use of your capital. We have no tracking errors, and you can able to trade your price directly. Other advantages of CMC Markets include local support, trading education, and timely market analysis from our team of analysts around the world. If you're still trading ETFs and looking for a better way to achieve your goals, contact CMC Markets here in Canada. We're at 120 Adelaide Street West in Toronto. Thank you very much, and that concludes our video on the benefits of trading with CMC Markets over exchange-traded funds.